Welcome back to the Daily Crypto Roundup. Today's market action has been a perfect example of why crypto can feel so confusing in real time. We saw prices lift, confidence start to creep back in, and then, almost like clockwork, the market hit a familiar level and dropped sharply again, in almost the exact same way it did yesterday. That kind of behavior naturally raises questions, because on the surface it looks irrational. Why move up at all, only to give it back so quickly? And more importantly, what actually caused it? That's what today's episode is about. We're going to keep everything grounded in what we can see, what we can verify, and what actually makes sense structurally. We'll look at why the market rose in the first place, why it rolled over again, why this keeps happening at the same levels, and what credible analysts are saying about it, without jumping between contradictory narratives or pretending the market knows something it clearly doesn't. Before we get into it, a quick reminder about the XRP giveaway. One comment will receive 10 XRP, and another comment will receive 5. Winners will be announced on Friday. Just leave a comment and reply to the message we respond to with your XRP address. Now, let's start with the market itself. Earlier today, crypto prices began to move higher. Not aggressively, not explosively, but enough to change the tone. Bitcoin lifted first, Ethereum followed, and parts of the broader market ticked up alongside them. The important thing to understand is that this wasn't a sudden rush of speculative money flooding back into crypto. It was a reaction to conditions improving at the margin. Right now, Bitcoin is trading at about $86,000, showing a modest rise on the session. Ethereum is around $2,821, also slightly higher. BNB sits near $831 with a small uptick, and XRP is trading around $1.85 with mild positive momentum. Solana is roughly $122. Dogecoin is at about 12 cents, Cardano is near 35 cents, Litecoin is around $74, Avalanche trades near $11.50, and Polkadot is about $1.77. Again, modest moves not far off their current ranges. These numbers reflect a market that's moving up in part with today's sentiment shift, but still well within the broader range we've been watching. Macro played a role in all this, along with softer inflation data, which then helped ease pressure across risk assets. And when that happens, crypto often benefits quickly, because it's one of the most sensitive markets to changes in liquidity expectations. At the same time, we saw renewed interest through spot Bitcoin ETFs. ETF flows have become one of the most consistent drivers of Bitcoin demand over the past year, and even modest inflows can shift sentiment when positioning is already cautious. That combination, slightly better macro conditions and steady institutional demand, was enough to lift prices. But it's critical to be clear about what this was and what it wasn't. This wasn't the market declaring a new bull phase. It was the market responding to relief. And then, once again, price hit a familiar zone and rolled over sharply. That's the part that needs explaining, because it's happened twice now, almost back to back. When something repeats this cleanly, it's usually not random. The first thing to say is this: fundamentals did not suddenly collapse in 10 minutes. Nothing material changed about Bitcoin's long-term outlook, Ethereum's roadmap, or the broader crypto ecosystem between the high and the pullback. What changed was structure. When price revisits the same resistance area multiple times, liquidity builds there. Stops accumulate. Leverage increases. Short-term traders position aggressively, because the level feels important. And when that happens, price becomes extremely sensitive to any catalyst. Not because the catalyst is huge, but because positioning is fragile. Today, there was a credible catalyst. Multiple outlets reported that a key US Senate crypto bill has effectively been pushed back to 2026. That headline landed right as price was testing the same level it failed at yesterday. In a strong, confident market, that kind of news might barely register. In a fragile, range-bound market, it can be enough to flip sentiment instantly. Reuters, in its reporting today, highlighted that while the crypto industry has made tangible regulatory progress in 2025, comprehensive reform remains stalled, and that ongoing lack of clarity continues to weigh on investor confidence. That framing is important. This wasn't bad news in the sense of a ban or a crackdown. It was uncertainty. And markets hate uncertainty most when they're already undecided. Let's pause here for a quick word from our sponsors. Stay with us. There is still a lot to cover.
Hi, it's Sarah Gibson Tuttle, the founder of Olive and June. Can I tell you the one thing that always makes my day better? A fresh manicure. But here's the thing, who has the time or budget to go to the nail salon every week? That's why we created the Olive and June Gel Mani System. It gives you that same glossy, long-lasting mani you get at a salon for so much less. It comes with everything you need, a pro-level LED lamp, salon-grade tools, our damage-free gel polish that lasts up to 21 days. Just prep, paint, cure, and you're good to go. And the best part, it's so easy and super affordable. So skip that $80 salon appointment. Get that salon quality look at home on your schedule. Head to oliveandjune.com/ManiMagic20 and use code ManiMagic20 for 20% off your first gel system. That's oliveandjune.com/ManiMagic20, code ManiMagic20 for 20% off your first gel mani system.
So what we saw today wasn't panic selling, it was de-risking. Price pushed into resistance. Traders saw uncertainty re-enter the picture, and leveraged positions unwound quickly. Stops were hit, longs were flushed, and price snapped back. That's why the move down felt sharp, even though volume didn't suggest broad fear. Several analysts covering the move described it as a classic liquidity-driven rejection rather than a sentiment collapse. In other words, the market wasn't changing its mind about crypto. It was changing its exposure. This interpretation is reinforced by what we saw elsewhere. Barron's reported today that crypto-exposed equities like Coinbase and Robinhood were actually moving higher even as crypto prices dipped. That divergence matters. It suggests that structural interest in the space hasn't disappeared. Capital hasn't fled. It's waiting. There was also commentary today around corporate Bitcoin accumulation. Analysts covering strategy noted that while the company continues to hold a massive Bitcoin position, funding costs and balance sheet considerations could limit how aggressively corporate buyers step in at elevated levels. That matters because it highlights a key dynamic in today's market. Interest exists, but urgency does not. In previous cycles, urgency came from fear of missing out. Today's market is different. Institutions don't chase. They allocate, reassess, and wait for confirmation. That makes price action slower, choppier, and more frustrating, but also more deliberate. On the asset-specific side, opinions remain divided. XRP analyst Alex Cobb argued today that buying XRP under $2 is, in his words, basically stealing it, suggesting that regulatory progress and adoption fundamentals aren't yet reflected in price. Whether you agree with that framing or not, it highlights the broader theme. Long-term narratives and short-term price action are not aligned right now. Ethereum sits right at the center of this tension. It's up on the day, but still below a level that would signal real strength. ETF flows have been inconsistent. Sentiment has been mixed, and price reflects that ambiguity. Ethereum isn't weak, it's unresolved. Altcoins tell a similar story. We're seeing selective strength rather than broad participation. Some names attract interest on specific narratives, but rallies fade quickly. Liquidity is thin, and traders are cautious. That's exactly what you'd expect in a market that hasn't chosen a direction yet. And that brings us to the bigger picture. What today's action really shows is that the market is testing conviction. Every push higher asks the same question. Is there enough demand to sustain this move? So far, the answer has been, not yet. That doesn't mean the move was pointless. Each test tells the market something. It flushes leverage, clarifies where real buyers are willing to step in, and slowly builds the conditions for a more decisive move later on. This is also why it's important not to frame today as a failure. The market didn't break. It reacted exactly as a fragile, range-bound market typically does. Strength into resistance, uncertainty enters, positions unwind, price resets. And until one of two things changes, either conviction improves or uncertainty clears, this kind of behavior is likely to continue. What all of this really comes back to is context. Markets don't move in straight lines, and they don't wait for clarity before they act. They move through phases of tension, release, and reassessment. Right now, crypto is firmly in that reassessment phase. Bitcoin remains the anchor. It continues to lead the market, not through explosive upside, but through relative stability. Even after today's rejection, Bitcoin is still holding well above its recent lows. That matters. It tells us that despite the volatility, there is underlying demand willing to defend higher levels than we saw earlier in the year. But at the same time, the repeated failure to hold above resistance tells us that conviction is still missing. Ethereum's position reinforces that reading. Ethereum has moved with the market, but it hasn't taken control. It's participating without leading. And that's exactly what you'd expect in an environment where capital is cautious. Developers keep building, institutions keep watching, but price waits for confirmation. That's not weakness, it's hesitation. Altcoins remain the most revealing part of the picture. When markets are confident, capital spreads outward. When markets are uncertain, capital contracts inward. What we're seeing now is contraction. Liquidity is selective, narratives are narrow, and rallies are short-lived. That doesn't mean opportunity is gone. It means selectivity matters more than usual. Analysts have been fairly consistent on this point today. The common theme isn't doom or euphoria, it's restraint. The market isn't pricing in disaster, but it isn't pricing in a clean breakout either. The Senate delay to 2026 didn't change crypto's long-term trajectory, but it reminded participants that regulatory clarity is still incomplete. And in a market already sitting at key levels, that reminder was enough to cool things off again. There's also an important macro factor sitting just ahead of the market that's likely contributing to this hesitation. Tomorrow, the Bank of Japan is expected to announce its latest interest rate decision, with markets widely anticipating another hike that would take Japanese rates to their highest level in decades. Japan has long been a source of cheap global liquidity, and when that liquidity tightens, it tends to ripple through risk assets worldwide, including crypto. Historically, periods where the Bank of Japan has tightened policy have often coincided with increased volatility and downside pressure in Bitcoin. Not necessarily because of crypto-specific fundamentals, but because global capital becomes more cautious. With that decision looming, it's not surprising to see traders reducing exposure, reacting quickly to headlines, and hesitating to commit aggressively, which helps explain why we're seeing sharp pushes higher, followed by equally sharp pullbacks. This is also why today's drop shouldn't be mistaken for a rejection of the broader thesis. It was a rejection of timing, not of direction. Markets often need to test the same levels multiple times before they can move through them with confidence. Each failure clears excess leverage, conditions participants, and gradually reshapes positioning. From a behavioral standpoint, this phase is uncomfortable because it offers no easy feedback. Bullish arguments still exist. Bearish arguments still exist. Price moves just enough to trigger emotion, but not enough to reward conviction. That's typically where patience is tested the most. And this is where perspective matters. Short-term volatility doesn't invalidate long-term participation, but long-term belief doesn't require short-term certainty. The mistake many people make in phases like this is trying to force conclusions before the market has made a decision. Right now, the market is telling us one thing very clearly. It is still deciding. If conviction returns, through sustained ETF inflows, clearer regulatory signals, or stronger macro tailwinds, price will reflect that. If uncertainty deepens, we may see more of these sharp tests and pullbacks. Either way, reacting emotionally to each move is rarely productive. What matters most in moments like this is alignment between expectations and reality. This isn't a market built for speed. It's a market built for discipline. So yes, today's rise mattered. And yes, today's drop mattered too. Together, they tell a more complete story than either move alone. They tell us the market is active, engaged, and responsive, but not yet committed. And that's the key takeaway. Stay informed without being overwhelmed. Stay patient without becoming passive. Let the market show its hand before you try to play yours. Drop your thoughts below, hit like, follow the show, and as always, we will see you at the top.